Hello, everyone, and welcome back to Your Finance TV. What a treat we have today. Not only is it the weekly, it's not the weekly, it's the monthly review with Jay Pelosky. How are you, Jay?
Good, Scott, and happy to say that the monthly is pretty much put to bed. It's a lot of work. This one came out at 6,600 words with 30 charts and tables from 20 different sources. But I'm happy to say that our executive summary is only 1,200 words. So I think a pretty good distillation. And what we also did was we added in some specific chart references within the executive summary to kind of draw people into the full document. And so, excited to go through it with you. I think we're breaking new ground. That's exciting to us. And, some controversial points that we'll get into. So excited to go.
Great. Well, of course, people can sign up to Pelosky.com to get into these musings. Now, I think we've been doing these videos for nearly a couple of years now. This might be the longest title I think I've ever seen you have. The past is not the present is not the future.
That's because it's a big idea. Big ideas need big, long titles. You can't, it's not a 2-word or a 3-word, which, yes, I like short, punchy titles in general, but every once in a while, you need to go with something longer. And that title really sums up a lot of our thinking. And, this is the first monthly in 2 months because over the holidays we didn't write. And therefore, there's a lot bubbling up and you're ready to go and you're excited. And so in our view, the past, which, is COVID, right? We're out of the COVID era. We're not going back to the pre-COVID, low growth, low inflation, low rate world. We're going into something different. And thus the past is not the present and the present is not the future because we're in transition to something new. And that something new, we believe, is a period, multi-year period of better than expected global growth, moderate inflation, and a pretty attractive environment for risk assets. And we really focus on the idea that we're early cycle, right? Remember in our 2024 outlook, which we now did 3 months ago, we put in our 4 for 24 macro surprises. And one of those was a return to stability, which was number 3, and then a resolution of the debate between whether we are early cycle and entering a new growth upturn or late cycle going into recession. And we think the evidence is building that we are early cycle into a global growth pickup that's underpinned by a rate cutting cycle, a global liquidity cycle, a global earnings cycle. And so we really bring a lot of our work that we've been talking about for months and even years in some cases, our global CapEx boom, regionalization of supply chains, which underpin our tripolar world construct. So a lot of stuff that we've been thinking about. We think the time is now to make the case that the past is not the present and the present is not the future, and really encourage investors to, think forward, to not be afraid to be a blue sky thinker. I mean, one of the prompts for the title was 2023's, kind of abysmal performance by the forecaster community and the investment community, right? I mean, late 2022, it was a near 100% certainty of a recession in 2023. What ended up happening? 3% US growth. Wall Street had a consensus of a down year for the S&P in 2023. What happened? A 20% gain. And so I think, you're kind of a dereliction of duty if you don't really think about your process, if you were one of those folks who got it so badly wrong. Happy to say, TBW was not in that camp, never a recession believer, constructive on risk all year last year. And so we participated in what ended up being a pretty good year. But it's an exciting time. We're pumped about this monthly. As I said, 30 charts from 20 different sources. And, we think we're entering a new environment where the future is not like the present. And it really is going to reward those investors and those strategists and those sell side people who can think independently, who can be blue sky thinkers and not be beholden to historical models, because we're not, the present and the future is not like the past.
Okay, so let's dig into the monthly then. I'm obviously looking at the quick review that we have, the 1,200 odd words. We're going to start with climate, and you focus in there on clean energy and how the public companies are actually getting tattooed at the moment. Dig a little bit into more of that and why you think that, and where you can see some very interesting stats in there for the viewers as well.
Yeah, we did. Bloomberg NEF does some really good work on kind of collating and gathering information on kind of the new economy and climate change, et cetera. So, that there's a conundrum, right? On the one hand, record global spending on renewables, close to $2.8 trillion globally. I mean, that's a massive, massive market. On the other hand, and that spending led to record increase in renewable power generation, right? On the other side, you have the companies that are part of this, whether it's solar, whether it's wind, whether it's electric vehicles, whether it's the batteries for electric vehicles. And as you said, those things have been toasted, right? You look at LIT, which is the lithium and battery ETF, down about 40%. You look at ICLN, which is the clean energy, so mostly wind and solar, it's down 40% or more. You look at lithium itself, right? A key input for electric vehicle batteries. It had an 80% boom bust cycle in 1 year last year. And so we talked about how China is a big factor here, right? China spends more than the US and Europe combined on clean energy. They have for a communist country, they have a very capitalistic approach, which is, let 1,000 companies bloom, fight it out, and then go forward. And so you have, very cutthroat competition, which is now starting to spill over into the US and Europe as those winners, like a BYD in electric vehicles, which is now taken over from Tesla as the world's #1 EV producer, now starting to export into Europe. And you have the battery makers going into the US and around the world. And so there's this conundrum between, okay, we want to get cheap inputs into the transition to clean energy, but yet we want to kind of have some of that made at home, whether it's the US or Europe. And so you've got that tension, and we spend a fair bit of time on that. And then we talk about how fossil fuels are really starting to roll off the main stage. And we highlight how this year in 2023, solar and wind now account for more power generation in the United States than coal. And so we're at some of these tipping points, which suggest that ultimately that space is going to be a good one for investors. And there are opportunities, and we have focused on uranium and nuclear power. And uranium's been one of the best performing things out there year to date, up about 25% in our uranium mining exposure. So you've really got to be astute and pick your spots, but there are opportunities in the climate space even today.
Okay, well, let's move on to economics. And you have your macro surprise that you put out in October last year, and obviously some of those have been met already. But when I see the surprising data, and I put air quotes around the surprising data because you've told me all these surprises already. Is there any other surprises that you think might be coming through?
Well, we focused on the 4, right? Lower inflation, faster than expected, #1. Better than expected productivity, #2. Return to macro stability, #3. And resolution of that early cycle, late cycle debate, #4. We would say the first two are kind of, manifesting and have been manifesting, right? U.S. inflation kind of rapidly getting towards the Fed's target. Even got some confirmation for that with Chair Powell saying, we're done with hikes. We're likely to cut. We just want to see a continuation of good data. And then in Europe's case, we expect inflation in January was about 2.8% year over year. We expect that number to go down under 2% by the spring because they have very favorable numbers the next couple of months where, big inflation prints a year ago are going to fall out. So that's going to seem like a rapid disinflationary cycle there. So those two, and productivity is a big part of that, right? You have basically fully employed economies, both the US and Europe, and we just got the jobs number today, right? Full employment, record long runs of unemployment under 4% in the US. That's good for productivity because you're really, everyone is moving and working at a good pace, and you layer onto that AI, and you see that productivity numbers start to come through. And that's what's really good for the environment we foresee, which is better than expected growth with moderate inflation. And how do you get that? You get that by productivity enhancements. And that's also quite good for earnings. And so one of the things that we highlight, and again, reference some charts, is the Bank of America's global proprietary indice work. And B of A is obviously, we're TPW Advisory, we're a small shop. B of A is hundreds of strategists, economists, data jockeys, quants, and their data, their work is very supportive of our early cycle thesis. And that's what we really hammer on in this monthly. Early cycle, semiconductor cycle turning up as we speak, right? Home builders reporting unseasonably high strength over the course of the winter. You even had in the manufacturing data, the ISM data came out, new orders finally broke above 50 for the first time in 16 months. So even in manufacturing, you're starting to see the upturn. And it makes sense because consumption has been robust, right? Because people are working and people are having, real income gains after inflation. So real income gains, consumption leads to more production, and thus the cycle turns up. And so we were really excited about the B of A work and put about, I think we pulled 4 charts, I think, from that work because it really reinforces our thesis that we are early cycle. And that's critical because that has a big impact on how you're going to invest, and particularly how you're going to allocate across assets. Because remember, our global multi-asset model looks at and invests in ETFs, but across the space, equities, fixed income, currency, and commodities. And if we're early cycle, that commodity space could be interesting.
All right, Jay, I'm going to give you a little bit of trivia for you as we go to politics. Who were the 2 presidential nominees in 2020?
I believe that was then President Trump and Joe Biden.
Okay, and who played in the Super Bowl that year?
Oh my gosh, you're really pressing me. Yes, the 49ers who now I'm spacing for another
Kansas City.
And Kansas City, thank you. Yes.
So if are we going to see a replay of 2020? I hope not with COVID, but do you think we could see a replay of 2020?
I do reference a couple of football stories in this monthly, one college, one pro, as we did a couple of weeks ago. But I didn't cotton on to the fact that we're redoing the Super Bowl 4 years ago. Wow, that's interesting. No, we do make the case, though, and we focus again on politics in a big fashion on our view that if Trump, former President Trump, makes it onto the ballot, which is not a guarantee at this point, he will lose by a landslide to President Biden. And virtually everyone we've talked to about this thesis has told us we're crazy. But we think the wind is shifting, that the tide is turning, that former President Trump is losing in court. His performance in Iowa was not great. Less than 10% of registered Republicans in Iowa caucused for former President Trump. In New Hampshire, Nikki Haley won the independent vote 61 to 37%. And we think that former President Trump has had to ratchet up his rhetoric to continue to attract his biggest base, his most fervent supporters, which at the same time turns off a lot of independents who he will need if he's going to make a significant run at current President Biden. And so we're of the view that Nikki Haley is taking the fight to Trump, unlike in 2016 when the Republican other candidates just folded like cheap suits. Nikki Haley is actually fundraising off Donald Trump, making money off the Donald, which is not the way it normally goes. Trump has had to spend $50 million of his supporters' money to pay his legal fees, to lose badly, certainly in the defamation case that was just resolved, and imminently in the New York fraud case. So the balloon has been punctured. In our view, the aura, even within the Republican Party, as Chris Christie and now Nikki Haley really go after Trump directly, is going to have an impact. And then the other side, you have President Biden, who continues to notch up win after win, whether it's rising home prices, record low unemployment, record high stock prices, whether it's rising consumer sentiment. And that really dovetails nicely with polling. So obviously the polls today, which we think is too early to pay attention to, those polls are not favorable for President Biden. But as that consumer sentiment picks up, as recession fears go away, as real income gains are sustained, then we think that polling will improve. And in the meantime, President Biden has $117 million in the bank. It's a record for any Democratic nominee at this point in the cycle. So Biden is banking wins on the economy, has money in the bank, versus former President Trump, no money. I think the RNC has less than $10 million in its account. Trump is hemorrhaging money to pay his legal bills, and Nikki Haley is beating him up, and she is now going to stay in the race at least through Super Tuesday in March. And so that's a case we work pretty hard in this monthly. The idea that former President Trump, will lose by a landslide, and we do that mostly because investor surveys say that geopolitics is their biggest concern, right? And the number one concern within geopolitics is the outcome of the U.S. presidential election. If it becomes clear that President Biden is likely to be reelected, that fear dissipates, and that provides another underpinning to this idea of a solid year for risk assets in a new cycle. And that's really why we pay so much attention to it.
Okay, well, let's move on to policy then. Obviously, we had the Fed speak this week. There's still people out there thinking there's going to be 6 rate cuts this year. I think they're out of their mind, but it's not just the US you're looking to cut rates, right?
Exactly. Well, a couple of things. First, our view is that it's the why the Fed will cut, not the when. And we've talked about this before, but very quickly, when the Fed cuts because inflation is better behaved and real rates are high and thus potentially restrictive, that's good for stocks. When the Fed cuts because a recession is imminent, that's not so good for stocks. And by the way, when the Fed cuts and we're near all-time highs, which has happened 20 times in the last 50 years or so, 20 times stocks are up a year later. So that's also not a bad thing to have happen. And look, we are, as you point out, we are big believers that we're early in a global rate cutting cycle that is being led currently by emerging market central banks. And just this week, to prove the point, you had Brazil, Chile, and Colombia all cut rates. And by the way, for all three of them, it was, I think, at least their second cut. Several of them have cut 3 or 4 times already because they raised rates ahead of the Fed, now allowing them to cut rates once the Fed goes on hold. And so we are in the camp of it doesn't matter when, it's the why. We expect rate cuts from the Fed and the ECB late spring, early summer. We think 3 or 4 cuts are probably going to be pretty much it for the Fed, in large part because our growth expectation consensus is 1.5% for 2024 U.S. GDP growth. We would think it's going to be north of 2%, and therefore less need for the Fed to raise rates. And so really, though, the action policy-wise, in our view, is going to be in Asia. And we wrote about that in a recent musing, saying the action is elsewhere. So you have in Japan, the BOJ shifting from, talk about the past is not the present, right? Japan's past is deflation, right? Now they've finally got inflation. And so they can move off of negative interest rate policy and yield curve control towards a new environment, a new future. Really good example of what we mean in our title. And then in China, of course, you have lots of policy action trying to gain traction, right? Bloomberg reported 8 separate steps, policy steps in January alone. Hasn't quite caught fire yet, right? I call China the slow burning fuse, right? All this action had not yet had an impact on risk prices, in large part because consumer confidence remains down in the dumps in China, which makes sense. I mean, just contrast the US and China. US, record household net worth, record stock prices, okay? China, house prices falling, stocks down 40% from their 2021 peak. And so you can understand why that confidence is lagging in China, and that's what the authorities are really trying to prop up with these policy actions. One other point real quick on China is that many people may have read about Evergrande, the formerly big developer being forced into bankruptcy. We believe that's a lagging indicator, and we look at Bloomberg's China Junk Bond Index as a idea of what's happening in that space. Most of those junk bonds are property related, and that index bottomed 5 months ago. And so we think the property market is in fact bottoming. Have some good charts on that in the monthly, and we expect these policy steps, small though they may be, to gradually take hold and lift consumer sentiment, which would help in turn lift stock prices. And in the interim, the risk reward we think is pretty attractive given valuation and the fact that at 5% GDP growth, companies are doing reasonably well on the earnings front.
And this all wraps up into markets. And listen, it's been a big week for earnings. You've had the Super Six Pack, as I'm referring to as. You had 5 of the companies reporting there, except for NVIDIA, which is in a few weeks. Just as a sidebar on NVIDIA, you hope that they take out their 52-week high, which was set early today at 666. Not a good number to be left on for the day, so hopefully it gets through that later on today. But give us a summary on the markets then, Jay.
Yeah, NVIDIA has been a monster, right? Absolute monster. And in the market point, we touch on the market section rather. We touch on several points. First, that the 20% run we've had in the last couple of months is typically seen coming out of into up cycles, not going into recession. The other point we would make is that in November, we were very focused on the 4 for 4, that you had sentiment, positioning, seasonality, and technicals all lined up in favor of getting long risk. That's no longer the case in the US, right? Virtually all four of those are cautious to kind of not really supportive at the moment. And that's, again, why we talk about, we look for the action elsewhere. China now has that situation, right? Seasonality going on Chinese New Year. Certainly sentiment cannot be more depressed. Positioning cannot be worse. Valuation, China trades at 8 times earnings. 8. The U.S. is at 20. China is at a record low 50% discount to the rest of the world on a valuation basis. Record low. And by the way, the same holds true in terms of Europe at a record valuation discount to the United States. So there's a lot of opportunities elsewhere. And so on a near-term view, particularly in regards to U.S. equities, we're reasonably cautious. On a 6, 12, 24-month view, we're quite constructive on risk assets. At the moment, we favor laggards like small caps in the developed markets. We're long EM equity and debt. We're long commodities. So we're from a broad asset allocation perspective, we are overweight equities. We are deeply underweight fixed income and very much focused on credit. Don't really see the opportunity set in U.S. Treasuries that others talk about. We think at under 4%, the 10-year is not particularly attractive, for example. We do like, and we're overweight commodities. Pretty much, we touched on uranium, but from gold to copper to uranium, there's a lot of action where a little bit of supply shut in, which we're seeing in uranium and copper, with the demand pickup that we're expecting, can lead to some really big price moves. And that's where we think the action is going to be. And you touched on, to finish up on tech, you touched on NVIDIA. We push back against the idea that it's just the Magnificent Six or Magnificent Seven. And note that the Russell 3000, which has 98% of the US market cap, has just hit an all-time high. So it's not just 6 stocks, right? We also push back against the idea that when you look at Magnificent 6 or 7 and you look at NVIDIA, it's like 1999 again. Completely disagree with that thesis. And we have a great chart from Dr. Ed Yardeni from his work showing that the valuation of NVIDIA has collapsed even as the stock price has gone up 200 to 300%. Okay? So this is very atypical, but is really, really important to understand. Earnings are growing faster than the stock price is going up. So the valuation, NVIDIA has traded on average for the last 5 years, 5-year average valuation, 40 times earnings. Today, after the earnings explosion that it's enjoyed as AI really kicks in, and NVIDIA is the poster child for AI, current valuation is 25 times earnings. So it's really unusual when you have the bell cow, the poster child for the new thing, and the new thing is the AI revolution, which we're big believers in. The new thing, the poster child, 25 times earnings versus 5-year average of 40 times earnings. The whole semi-cycle turning, we completely push back against the idea of 1999 having any relevance to where we are in the tech cycle at the moment. So constructive, medium to long term on risk assets, overweight equities, little cautious on the US right now. Overweight commodities, see that as really the winner of the early cycle upturn that we expect to see in the global economy. Not really all that keen on fixed income. Do like credit, both developed and emerging market credit in fixed income space.
Just remember that, Jay, the super six-pack I'm referring to it as.
A super six-pack. Perfect for an upcoming Super Bowl. But hey, let me ask you a question, sports related, my friend.
Yeah.
You know what's going to be on TV tomorrow?
Is it going to be Duke versus North Carolina?
Yeah, you read my, you went all the way to the end. Congrats. Yes, I write about football in the monthly, but it's basketball season for the most part. And tomorrow does bring up yet another Duke Carolina basketball game. And the Blue Devils are traveling down the road a mere 9 miles to Chapel Hill, where I am quite confident they will come out with yet another Blue Devil victory. Go Duke.
Well, best of luck with that, Jay. I'll be watching some Six Nations rugby over the weekend. Actually, we'll be shortly too. Have a great weekend, Jay. Thank you so much for your time, and we'll talk to you again next week.
All right, buddy. Enjoy the game.
And for everyone else out there, good luck investing.